Hey, what's up guys? T.Mayne back again with some more value added content. It's super awesome to have you guys back on the channel. Now in today's video guys, we're going to be going over the two most important things that either define a trader as a winning trader or a losing trader. Now when I say winning trader and losing trader, I mean both winning trader and losing trader in terms of actual results, in terms of the reward that you get to take home out of the market, and I mean psychologically as well. What makes a psychologically losing trader and a psychologically winning trader? Now guys, the two most important things that we're going to get into are our win rate and our risk to reward ratio. Now let's get into risk to reward ratio. Simply put, the risk to reward ratio is the amount we're prepared to risk compared to the amount that we expect to gain, which is our reward. Now, risk to reward ratio obviously has probabilities involved. If we have, for example, a risk to reward ratio of 1:1, we are risking 1%, expecting to make 1%. And considering the distance from our entry, if we look at things from terms of entry, we enter here, our target is here, our stop is here, or our stop is at the bottom, our target is on the top, whatever, and we are risking, or the price is expected to close our order an equal distance away from our entry and away from our stop. So if we look at things in terms of probabilities, price has an equal probability of hitting both our take profit and both our stop loss. Now what happens if we skew things just a little bit? Let's say we trade with the normal risk to reward ratio that a lot of traders love using, or that a lot of traders are taught to use. Risk to reward ratio of 1:3. That means our stop loss would be here, our target would be 3 times away from our entry. What that means in terms of probabilities, it means that price is 3 times more likely to hit our stop loss than our target area. So if we think about this maybe in terms of percentage, maybe price has a 66% chance of hitting our stop loss, and price has a 34% chance of actually hitting our take profit. So can you see, just because we have an increased risk to reward ratio, our trade is more likely based on distance, price distance away from our entry. Price is more likely to hit our stop loss than it is to hit our take profit. Now we're going to see why this is important when we further discuss and join the two. Now the next thing we want to talk about is our win rate. So our win rate is basically how often we win. Do we win 7 out of every 10 trades that we take? Do we win 5 out of every 10 trades that we take? That is our win rate. Now a very scary thing about win rate is that your win rate is calculated and determined by your sample size. So how large your sample is will affect the actual value of your win rate. Let's say we take 4 winning trades out of 5. That clearly shows us that we won 80% of the total amount of trades that we have taken. That would mean that our win rate would be 80%. Now, let's say we continued to take trades and we still only won 4 out of every 10 trades that we took. You see, the first time our win rate was 80% because we took 4 out of 5 trades, winning trades. Now, 4 out of every 10 trades that we have taken were winners. So our win rate, now that we have increased our sample size, our win rate is now only 40%. Now, it's unfortunate that probabilities affect how when we win more than we lose, and when we lose more than we win. Things like price action, market cycles, fundamentals, whatever general market cycles that happen, all of those things determine when we would be in a winning streak and when we would be in a losing streak. And unfortunately, we don't have we will never have an accurate representation as to what a specific sample size, whether a specific sample size is enough for us to get an accurate value on our win rate. We can backtest 100 trades, and out of our 100 trades, we can win maybe 80, and we'd have an 80% win rate. But if we took 160 trades and the rest was still losses and we still only managed to win 80 of that 160 trades, you see how now we moved from an 80% win rate down to a 60% win rate, just because we tested more and we have more information. Now, obviously, your win rate can also improve if you test more and you find out that you win more on a larger sample size. So win rate is something, guys, that we really will never be 100% accurate. We will never 100% be able to say that this is my win rate, because our sample sizes are always changing, and our data, our win rate will change according to the new data that we include into our sample size. The more we take trades, the more information we get on our strategy and the actual outcome. So win rate is something that will change over time. Risk to reward ratio, guys, is something that we as traders have control over. Now, let's look at something here. So, guys, there are few types of traders. Some people are traders that basically have a higher win rate. Remember, guys, we spoke about the probabilities when we looked at risk to reward ratio. We said that the closer your TP or the closer your SL is to your entry, the higher the probability price has of hitting that area first than it does of hitting, obviously, the TP or the stop loss that is further away. So obviously, guys, someone that has a risk to reward ratio of 3:1, where their stop loss is, where their take profit is closer than their stop loss, and a lot of short time frame traders make this mistake and get confused by having a higher win rate where they hit their TPs a hell of a lot more than they hit their stop losses. But when it does happen that they do hit their stop loss, that drains a lot of money from their account. Now, the only reason why that happens, they have a good psychological winning mindset because they're hitting take profit 20 times in a row and they're all okay. And then those few trades that go against them really demotivate those traders and really put them in a bad psychological headspace. Hence why we said that I'm going to describe the difference between winning and losing traders, both in terms of results and in terms of psychologically. Traders that have a risk to reward ratio like this are more prone to be more psychologically unstable than someone that has a positive risk to reward ratio, because this type of risk to reward ratio rewards you instantly and then wipes out everything that you've been positively reinforcing yourself, about telling yourself that you're the best trader, that you're so good, you're winning trades one after the other. Yet this one trade that does take you out really sends you from hero straight all the way to zero. And that produces a psychologically unstable trader. Now, there are other traders that have an equal risk to reward ratio of 1:1. All that means is that probabilities of price hitting your TP or hitting your SL are equal, 50-50. And obviously, people that trade with a minimum risk to reward ratio of 1:3, where their stop loss is closer than their take profit, they have a higher percent or higher probability of trades hitting their stop loss more often than the trades that basically hit their take profit. And that's just based off the distance from the entry and where you're planning to exit your position. Now, what we can do by joining, let's just move this to the upside. What we can do by joining risk to reward ratio and win rate is determine what our win rate needs to be according to the risk to reward ratio that we have set. So I've drawn out numbers down low so that we can begin to properly visualize what I'm talking about. So for us to be profitable with a strategy that has a risk to reward ratio of 3:1, we would need to have a win rate of 80%. What that means is that we would need to win 8 out of every 10 trades to be profitable. Now, you can do just a quick back check on your own strategy and make a decision on whether or not you win 8 out of every 10 trades. If you do, then you could be profitable with this type of a strategy that gives you a risk to reward ratio of 3:1. Now, if you traded a strategy that used a risk to reward ratio of 1:1, you would need a win rate of 5 or more trades, 5 out of 10 trades or more to be profitable. Now, this is as good as a coin flip. Now, if you trade with a risk to reward ratio of 1:3, you would need a win rate of at least 3 out of every 10 trades to be profitable. How do we now actually just visualize this? So, if we were risking 1% with a risk to reward ratio of something that looked like that, and let's say we had a 70% win rate. So that means we won 7 positions, gaining us +7 on our account, and then we lose obviously the remaining 3 trades. Remember, risk to reward ratio of 3:1, so we got 1% 7 times, and we lost 3% 3 times. So 3 times 3 is 9. That means -9. See how with a 70% win rate and a strategy that has a risk to reward ratio of 3:1 still gives you -2% in the long term. Even as much as you have been winning countless times after countless times by hitting TP over a long period of time or over a large sample size, if your strategy has less than 80%, you will lose money. Not because your strategy is bad, but just because of the numbers of statistics and probabilities. You will lose money. There is no question about it that if your win rate is less than 80% with a strategy that offers a risk to reward ratio of 3:1, you will be at a negative. You will end off long term at a negative. Now, let's look at obviously the inverse. If we had a strategy that won more than 30%, let's just say we had a strategy that wins, let's just be realistic and say 50%. We had a strategy that won 5 out of every 5 trades. Now, that would mean that we would obviously lose 5 trades, so that's minus 5, and we would win 5 trades, and 3% on every 5 trades that we are taking. That means 3 times 5, that's 15. That means we've made 15%. Minus 5 plus 15, that would give us a positive return of 10%. Now, even if we had this minimum win rate of 30%, meaning out of every 10 trades, we lost 7 and won 3. 3 times 3 is 9. That means we're up 9%. Minus 7 plus 9, that still puts us up 2%, even if we win 3 out of every 10 positions that we take. Now, guys, this is basically, I wanted you guys to see the trade-off of risk to reward ratio. Would you rather have a strategy that has a higher probability of hitting your stop loss and making you feel uncomfortably psychologically, because that's how a lot of traders interpret the information when their trade hits stop loss? Would you rather have a strategy that hits stop loss more often than not, but still puts money in your bank account at the end of your trading month or your trading year, or whatever the time scale you're measuring your trading progress by? Would you rather have a strategy that hits stops more and still puts money in your pocket, or a strategy that hits take profits more, but at the end of the month you're still left psychologically damaged because you've been losing money with your amazing strike rate, but your poor risk to reward ratio still is making you lose money? So anyway, guys, this is all I wanted to kind of emphasize. I wanted to emphasize the difference between obviously a good trader and a bad trader, a winning trader and a losing trader. And we can obviously see what the characteristics, or at least the trade characteristics, of a winning trader would be. Someone that uses a good risk to reward ratio, and someone that has a win rate, or at least an expected win rate, of more than 30%. And let's be fair, guys, we've all worked so hard to develop ourselves as traders, and we've learned strategies and things to do in the market that can definitely give us a win rate of more than 30%. At least, guys, we can win 3 out of every 10 trades. But if we use a positive risk to reward ratio, like a risk to reward ratio of 1:3, we will still make money. And we will still include room for us to make those mistakes and still learn how to evolve our strategy, how to get better, how to use new tools, how to use all of those things. We'll still be able to take a lot of those losses and a few wins and still make money. Guys, that is the point of trading itself: managing your risk and expecting at the end of the period of time that you measure your trading success or your trading progress by, expecting a positive return. And the only thing that you can use to cheat the system, to rob the system in Forex, is to have amazing, legendary, beautiful risk management skills. And a risk to reward ratio that has a positive return, like a risk to reward ratio of 1:3, is going to be that first change that you make within your trading that will start giving you the type of outcome that you're looking for long term. Remember, we don't want these short term gains followed by long term losses. We want short term losses followed by long term gains. That's how Forex works. That's how any investing works. And that's how you will stay and remain psychologically healthy. That's how you'll be able to still attack the market with the same consistency, because you understand the probability that long term you will still make money and that you're not defined by the amount of losses that you take, because you have the statistics and the probabilities on your side that even with a strategy with a low win rate, you can still make money. Now this is obviously, like I was saying, the difference between a winning trader and a losing trader. Guys, be the trader that employs good risk management in the form of a risk to reward, or a strategy that includes a risk to reward model that will provide you with something beneficial long term. Now guys, this is T.Mayne. Obviously I love for you guys to wait until the end of the video to actually drop that like after you've received the value, after you've watched this video, to see if it fulfilled the needs, the reasons for you actually clicking on this video. This is the time to drop that like, guys. I would appreciate seeing your guys' feedback on how you enjoyed the content and if you gained some sort of value.
So please,
otherwise, this is me for this video, and I'll see you guys in all the future value added content that we're going to be dropping on the weekly. I'll see you guys later. This is T.Mayne. Till next time, cheers.